this may be the time when we make the decisive breach of that $2,000 level and go on to set new highs, quite possibly a good deal higher than where the previous high was.
We're here now with George Milling-Stanley, Chief Gold Strategist at State Street Global Advisors, with more than 50 years of industry experience analyzing the gold market. And today, indeed, we are focusing on the gold market, harnessing George's wisdom. George, welcome to the show. Welcome to my new show, The David Lynn Report.
David, thanks very much for inviting you. Congratulations on the new show. I look forward to being a regular attendee.
Thank you very much. We look forward to your insights. George, by popular demand, my audience has actually requested that I interview you and get your insights on what's been happening with gold and, more importantly, the drivers around gold, which people find interesting as well. So maybe set us up here. The macroeconomic drivers that have propelled gold to $2,000, what were the main ones?
Oh, I think, inflation, there's no question about that. Inflation is front and center in most investors' minds, especially in this country when they think about gold. We have inflation at a 40-year high, or we have had inflation at a 40-year high. I think that has been helpful for the gold price, no question, over the last year and a half, let's say. And the fact that inflation, it's wonderful news that inflation has fallen on the CPI from around 9% level to around the 5% level. But if you go back just a year and a half, 5% would have been totally unacceptable. And now we seem to be welcoming the fact that inflation is a mere 5%. Inflation is very, very sticky. Paul Volcker found that it was very difficult to deal with what was by then, in the early 1980s, was by then embedded inflation embedded inflation expectations. And I have a horrible feeling that we may already be in that kind of period where workers expect prices to go up, so they ask their employers for wage increases. Employers pay the wage increases, and then they put prices up in order to be able to afford them, at which point the workers come back and ask for further increases. That kind of vicious spiral, it seems to me we may well be in that already. The history books will tell us, but I'm guessing that's where we are right now. So I think inflation has definitely been one of the main drivers here. But there are a couple of things on the supply-demand balance that have been kind of helpful. One of these is China eventually abandoning the zero COVID policy toward the end of last year. That had been very harmful to jewelry consumption because China is frequently, it vies with India as the largest consumer of gold jewelry in the world. And when the Chinese economy is not performing, when China is in lockdown, then jewelry gets hit pretty badly. A number of us have been hoping for a rebound last year, with COVID seeming to ease globally. But with China keeping those restrictions on, those lockdown restrictions on, it looks like we are now going to see the rebound in economic activity and the concomitant rebound in gold jewelry demand this year rather than last year. So I think that's another driver that people should be looking out for if they're wondering what's going to happen in the rest of the year.
Just let's talk about inflation for just a minute. You are correct in that 5% inflation is still high by historical standards, albeit the fact that it's been coming down, the CPI rate of change, inflation has been coming down from 9%. But it's this rate of change I want to talk about because the direction of inflation has been down while the direction of gold has been up. So one might look at this relationship and say, that's odd. Certainly they should be moving in the same direction, no?
Yeah, you would expect them to do that. It's interesting, gold didn't respond as much as many of us expected to the very, very high inflation numbers we started to get last year. And I think part of this was because the Fed very quickly took action to raise rates, and that caused a serious strengthening in the dollar. We saw the US dollar last year at a 20-year high against just about any other currency in the world. And I think that if there was a headwind for gold last year, it was probably the extraordinary strength of the US dollar. This situation is very different from the inflation we had in the 60s and 70s in this country, when we had persistent inflation and relatively little action from the Fed or from the Treasury to do anything much about it until Paul Volcker was appointed as Fed chair in 1979. This time around, as I say, we've had pretty good, solid action, including the 375 basis point hikes that we saw in the fall of last year, which I think were a slap upside the head to the markets, who didn't seem to be taking Jerome Powell seriously when he said this is very sticky inflation. It is likely to be with us for some time. It's definitely not transitory, reversing his previous statements, and suggesting that he was going to have to raise rates further than anybody expected and keep them high for longer than anybody expected as well. So I think the markets began to take him a little bit more seriously when he did that. So I think that the raising of interest rates helped the dollar to strengthen right up until November of last year. But I think that kind of ran out of steam in October, November time. I believe the dollar peaked at that point. The trade-weighted dollar index fell about 4.5% in November of last year. And we've ticked up from time to time, but in general, the trend has been gradually down. The dollar's not going to fall off a cliff, but the trend has been gradually downwards since November of last year, and that's what I would expect to continue. And that's why I think gold has been responding, if you like, to last year's very high inflation figures and the perception that inflation is likely to be sticky. You know, there are some commentators suggesting that we could stick around the 5%, 4 to 5% inflation mark for quite some time, possibly even the rest of this year, as a lot of people do not see much prospect of getting back to the Fed's target of 2% by the end of this year. If that happens, then we're going to have interest rates around the 5 to 6% area. I think that that's quite possible too. That, to my mind, is a scenario that is going to be helpful for gold if indeed the dollar has peaked. And if the dollar's peaked, I think essentially what that means is that other currencies, the ones that were at historic lows against the dollar last year, other currencies are beginning to revert to the mean. And if that happens, other currencies strengthen against the dollar, then I would expect gold to continue to strengthen against the dollar too. That means a higher gold price in dollar terms.
Okay. I do want to come back to your dollar thesis, but first let's finish up on inflation. So what are your expectations for inflation in the short and perhaps medium term? We are speaking on Tuesday, a day ahead of the CPI print release. What are your expectations for tomorrow's release?
I think it would be folly for me to tell you what I think the number's going to be, because I have no inside information and I have no clue any more than any of the other commentators have a clue. But I still believe inflation at these levels is very sticky. It's going to be very hard to get it down. Wages remain high. We had a point last year when inflation was caused by too much money chasing too few goods. Now we have too much money chasing too few services, and that is showing through in wage growth in the service industries. I don't know whether the number is going to be under 5% or above 5%, but it will certainly be very, very close to the 5% level that we saw with the last reading a month ago. I'm guessing it could well be exactly the same. It could still be the 5.1% kind of area for the CPI when we actually see that number.
You're right. Wages are usually sticky. However, raw commodities have been coming down. Energy, for example, we've seen $120 a barrel last year. It's now at below $80, actually. Natural gas has fallen, lumber as well. So raw materials have gone down. What are your expectations for inflation going into the end of the year and perhaps next year? I've heard estimates as low as 2%, and estimates much higher than that as well. Where do you sit?
Jerome Powell has been sounding increasingly convincing and increasingly persuasive with each press conference that follows an FOMC meeting. And I think that the markets in general are beginning to listen to him. But the weakest thing that he has said at the last couple of meetings is when he said he still believes there is a reasonable chance, and he's not promising anything, but believes there's a reasonable chance that the Fed activity could actually get the rate of inflation on PCE, personal consumption expenditure, his preferred measure, could actually get that down to 2% by the end of the year. I think that has been the least convincing part of every statement we've seen from Jerome Powell for possibly as much as 6 months now. I don't believe he's going to be able to achieve that. It wouldn't surprise me to find inflation not markedly different from where we are today. You've mentioned the costs of commodities coming down, and I think that's absolutely true, especially energy commodities. No question about that. I think that it was primarily energy prices, in many ways fueled by the war in Ukraine, crimping Russian supplies. I think it was energy and food that really pushed inflation up above that 9% mark that we saw last year. If that's going to go away, then I think we're going to be left with inflation that is primarily a result of services, demand for services, and of course of the wage explosion that has followed that demand for services. I wouldn't be surprised to see inflation still in the 4 to 6% range, but even toward the end of this year.
Can you comment on whether or not you think we're entering a recession either this year or next year? Recessions are interesting dynamics, or present interesting dynamics for gold, because historically, if you look at past recessions, gold has done quite well during recessions. I've ran the numbers myself. Throughout every single recession going back to 1980, gold has performed at least positive. So it's gained throughout the course of the recession. However, recessions have historically also been disinflationary. So it's an interesting dynamic, because you wouldn't expect gold to usually perform well in a disinflationary environment, but yet they've done well. It's done well during recessions.
Yeah, no, you're absolutely right. I look my preferred sample size is the last 50 years, because that's as long as I've been involved in gold, as you said in your introduction. We've had 7 significant recessions in that 50-year period, and on average, gold's annual price appreciation over those 7 recessions was above 20%. And this is in a period when equities were in negative territory, bonds were going nowhere, most other assets were not doing anything very much. So 20% returns in recessions, I think, is very important. I'm guessing we probably will go into a recession. We may already be in one. It's really hard to judge when you're actually in that moment, Life can only be understood backwards, but it has to be lived forward. As I think Soren Kierkegaard once said, we will not know whether we're in a recession currently until the National Bureau of Economic Research tells us so in about 12 months' time, which isn't exactly helpful in terms of today's current planning. But my guess is that we will probably go into a recession. It will probably be fairly mild, and it will probably be fairly short-lived. And I hope that's not just my hopes talking. I hope that's my considered opinion talking, not just what I would wish to see. But I'm guessing that recession, I think, is definitely on the cards. Even if we just get a period of slower growth, it will be slower growth accompanied by inflation. And back in the 1970s in England, we used to call that stagflation. It's a thoroughly ugly word, and it's an ugly set of economic circumstances to live through, as I very vividly recall. Gold has always done very well in periods of slow growth. Gold did very well during the periods of stagflation that we've seen. So whether we get recession at one end, whether we just get stagflation, or whether we just get slower growth, I think nobody's expecting us to get faster economic growth over the rest of this year. So whatever we get, I think gold is likely to do well as a result of it. Maybe counterintuitive, because, as you say, recessions tend to be disinflationary, and historically gold doesn't really like disinflation, doesn't usually perform well during disinflation. But if people's focus switches from what the inflation numbers are to what the numbers on GDP growth or GDP contraction are, then I think that gold can do very, very well. So the focus of people's attention will shift from inflation once we start to lose these very, very high numbers in a recession. But I think that the levels of economic activity will be front and center on investors' radar screens.
So why do you think that inflation will be sticky this time around, given that, like we've talked about, recessions have typically been disinflationary? But why is it that inflation will be sticky at around 4 to 6% this time?
I think that the Fed has talked a lot about wanting to avoid allowing inflationary expectations to become embedded. But as I said earlier in our conversation, I believe those expectations have indeed become embedded, even in a relatively short period of very high inflation. Unlike in the 1970s when we'd had 20 years of high inflation, so it was only natural that inflationary expectations were embedded. But remember what happened with inflation around 14, 15% a year in the late 70s. Paul Volcker had to put the Fed funds rate to 19.5% and keep it there for a period in order to finally bring the rate of inflation down to something he found acceptable under 10%. It was still around 4% that he deemed acceptable, but then after 14 or 15%, I guess 4% was a pretty good number to be at. I don't think that we're in the period when we're going to need to see interest rates go up that high because we don't have 20 years of embedded expectations. But I think we probably have a couple of years of people expecting prices to keep going up and taking action in order to try to address that issue in the form of wage increases or whatever they're able to do to increase their income. So I think that's really why I'm expecting to go into a recession, but a relatively mild one. And that, I think, because it will be a mild recession, that, I think, is probably what is going to keep the inflation numbers still pretty high.
The final question on inflation, and we'll move on to interest rates. Does the direction of inflation matter more for gold or the level of inflation? Suppose we have a very high level of inflation. Let's throw out a number. Let's say 8%. Mm-hmm. But we have a consistent 8% and it doesn't move for years. All else being equal, what would happen to gold in that scenario?
When inflation is moving and when inflation is moving up, then gold tends to gain momentum in moving up along with it. When inflation is fixed at a fairly high level, which is the scenario you're proposing, around the 8% level, then I would expect gold prices eventually to catch up to a level where people felt that gold was offering acceptable protection against that level of inflation. But think about the really important driver, to my mind, in most people's estimation, isn't so much what's actually happening to inflation, whether it's the absolute level or whether it's the direction. It's people's perceptions of where inflation is going to be next month, the month after, 6 months out. And if we have persistent inflation at, for example, around the 8% level, then there would still be plenty of people who are concerned that it could easily get to double figures fairly quickly, because that was the pattern that we had in the 1970s. And there are still some investors out there who remember the patterns of inflation in the 60s and 70s, and are very much afraid that those patterns could repeat themselves this time around. Perhaps partly because the Fed took a long time before it actually moved to start raising rates. You remember the Fed actually believed that inflation might prove to be transitory and entirely based on supply chain disruptions caused by the conflict in Ukraine. That all went out of the window quite some time ago, and I think we now have a much better understanding of the sticky aspects of economic life that are keeping those inflation numbers inflated and very, very high. 5% is way too high for inflation. Jerome Powell knows it. He knows how damaging a regular 5% inflation would be. So he's going to do the very, very best that he can to bring that down. But it's going to be hard for him to do.
The dollar-gold relationship you brought up is entirely accurate, because we've seen the dollar slide in strength over the last 4 months now. Oh boy, time flies. It's already May. The peak of the DXY was in October of 2022. Back then it was around 114. Now, as of Tuesday today, it's at 101. And throughout this time period, I've been seeing headlines of people being fearful of a continuation of this trend. I've even seen dollar collapse headlines pop up more than I've seen last year. Generally speaking, what is the state of the U.S. dollar right now? Is it collapsing, like some headlines would say?
Nope. Many people have predicted the collapse of the US dollar in the years I've been involved in financial markets. It has never collapsed, and I don't think it's going to collapse. We have had occasional periods of weakness. It's interesting to cast our minds back to 2011 when gold reached its previous peak, and to think about what was happening in 2011. You may recall that gold reached a peak, if memory serves, in September of 2011. on August the 5th of 2011 is when Standard & Poor's, for obvious reasons connected with the debt ceiling fiasco that was going on at the time, cut the credit rating of the United States. And I think that was very, very helpful for gold then. Does any of this sound vaguely familiar to you, David? I think we're going through exactly the same kind of political shenanigans that we went through then, that were extremely damaging to people's confidence in the U.S. government, people's confidence in the U.S. dollar. And I think that's part of what we're seeing now. But that doesn't mean collapse. I think that the pace of change in the international monetary system makes glaciers look like race cars. No question about that. It's very, very slow indeed. I think that the dollar is declining in importance and has been declining in importance for probably a decade now, but it is a very, very gradual decline. What I'm expecting to see from the international monetary system, and this obviously has bearing on what I expect to see from the dollar, is that the dollar will very, very gradually edge lower from its period of dominance, from dollar hegemony. I think that the euro will gradually recover its standing. I think that the Chinese renminbi, having been included in the special drawing rights now, that's kind of the seal of approval from the IMF for central banks to own the renminbi in their official reserves. So I think that we'll see gradually the rise of the renminbi. And I also think that we will see the continued increase in the importance of gold in international financial reserves, in official reserves of countries around the world. We've had this trend now for 13 years of central banks, primarily in the emerging markets, selling dollar debt because they were something like 2/3 of their reserves were in dollar-denominated instruments and less than 5% of their reserves on average in gold. So they've been selling dollar assets and buying gold with the proceeds for 13 straight years now. Those net purchases by primarily emerging market central banks reached an all-time record high last year, and records go back more than 70 years. So reaching an all-time high last year. They've started very, very strongly in the first quarter of this year, according to the most recent numbers from the World Gold Council on gold supply and demand, including central bank purchases. So the gold community is expecting another good year of net purchases by emerging market central banks. And I think that is going to be very, very helpful for the gold price going forward. It's been regularly somewhere between 10 and 15% of total global gold demand. That's significant in that balance between supply and demand.
That is a perfect segue to my next question, which is, you've set me up perfectly, which is why we've seen emerging markets buy the most gold on record according to the World Gold Council data. If you assume the gold, if you assume their data is accurate, that this is the 2022 was the year of the most net purchases in history, going back all the way to 1950. Why? What happened?
I think there's two things. One is the long-term trend that I've talked about. Since 2010, emerging market central banks have been primarily sellers of U.S. dollar instruments and buyers of gold with the proceeds. That's a long-term trend, and that is going to continue because in spite of 13 years of this activity, they still have the bulk of their reserves in dollar-denominated instruments, and they still, on average, emerging market central banks still have less than 5% of their reserves in gold. They're not going to, go to 2/3 in gold, but that is the direction that they want to go in, and that is going to continue for the foreseeable future. According to my friends in the central banking community, we can look for continued purchases by emerging market central banks. So that's one long-term trend that is going to continue. That helped to lead to the all-time record highs last year. And in the first quarter of this year, the World Gold Council has just told us that the first quarter of this year also saw record level net purchases. So I think that long-term trend is going to continue and be helpful. Then there's an added dimension to this that came into play last year, and what pushed us off the charts in terms of reaching that all-time record net central bank purchasing last year. And this is what some people have called the U.S. government's attempts to weaponize the international payment system. We tried this in 2015 by kicking Iran out of the SWIFT payment system. We did it again last year by kicking Russia. And this doesn't mean just the Russian government, but it means Russian corporations and the Russian population at large, by not allowing them access to the SWIFT payment system. And there are a number of other countries that fear that maybe they might upset the U.S. at some point in the future. Here I'm looking at North Korea, China, maybe Iran again. There are a number of candidates out there who have reason to be concerned that they might upset the United States government at some point in the future, and the U.S. government might continue to weaponize this system. So if that's an accurate description, that's what they're doing, they're certainly using the system for political purposes. I'm not sure I go as far as weaponize. But that really came in, as I say, last year as an additional impetus for countries around the world to shift out of the dollar and into this wonderful asset that is entirely anonymous and is universally acceptable, and it's called gold, and it's a very, very safe way for central banks and governments to hold their official reserves. And I think it is enjoying a resurgence in popularity, partly again as a result of this actions by the U.S. government.
Okay, and I do want to bring up this fact that actually one of my viewers brought to my attention, which is that as the price of gold itself has done relatively well, which is to say that it's neared all-time highs. The price of miners have not shared that good news. As you look at the GDX, for example, the VanEck Gold Miners ETF, which is a basket of large gold mining companies. It's currently trading at around $35. The all-time high was back in 2011, $62. So we're still about 50% lower than all-time highs. Why is it that the miners seem to be lagging gold?
I think there's a couple of things here. The only thing that drives the price of gold is developments in the price of gold. It's a very, very simple equation. It's a direct flow through from events in the gold market, if you like. That's not the case with the gold mining stocks. The price of gold, developments in the price of gold are just one element in all of the different drivers that drive company stock performance. Gold mining companies are subject to exactly the same kind of factors that any other company is. Are they good management, or is their management ineptitude? Are they lucky in terms of their management? Are they unlucky? Do they usually do successful merger and acquisition activity, or do they tend not to get it quite right? Are they in the right places geologically? Are they in the right places geopolitically? All of these kind of factors will factor into the performance of gold mining company stock, along with the contribution from movements in the gold price. Gold simply is gold and will move. Gold moves because gold moves. It's that simple. But there's a lot of other things go into the performance of gold mining company stock. One other thing to point out, gold mining companies for some time now have been spending record amounts of money on exploration and development for new gold ore bodies, and they've been doing this in greenfield areas where they've never looked before, and they've also been doing it in brownfield areas around existing mine sites, which is always a good place to look for more gold. And they are simply not finding new gold deposits at the rate that would allow them even to sustain current production, let alone show growth. And what shareholders want from mining companies is growth in their performance. So the only way that mining companies have been able to show significant growth in performance is through their merger and acquisition activity, when that has been sensibly based. And there's been a good deal of activity on that front recently. So I think that is the major reason why gold bullion itself has very definitely outperformed the gold mining stocks.
And putting all this together, then, are all these forces that we discussed today enough to propel gold to new all-time highs this year?
I think there's a very good chance that they will be. If you think about it, David, as you've mentioned, we've been flirting with this $2,000 level for more than 10 years now. And it often takes gold a long period of time to break through into new higher territory, to develop a new big figure at the front, to go from $1,000 something to $2,000 something. It's taken us 10 years already. We've made a couple of forays above that $2,000 level. At some point, I believe that we will consolidate above there. For 10 years, it has probably been the right thing for many investors, especially tactical players, to take profits whenever gold gets above $2,000. I think that that perception is gradually dissipating, and that more and more people are starting to think in terms of a new all-time high, and then gold going on to even higher highs after that, because historically that has tended to be the trend, that when gold does finally break through a level of overhead resistance, which then becomes downside support, and here I'm talking about that $2,000 level, when gold makes that final breach, then it often doesn't just go $100 higher, it can go considerably higher and quite quickly too. I think a lot of people are starting to think that this may be the time when we make the decisive breach of that $2,000 level and go on to set new highs, quite possibly a good deal higher than where the previous high was.
I'm curious, final thoughts. I'm curious as to why you've decided to spend the bulk of your career studying the gold market. I mean, 50 years is considerably long time relative to other people's careers, and no doubt you've developed a tremendous amount of expertise in the space. But why?
One simple response: it's never been boring, David. It's never been boring. It's why I get out of bed in the morning to find out what has happened to gold. I may sound like a bit of a wonk there, but I've been endlessly fascinated. The more I learn about it, the more I realize that there are more areas that I want to delve into. I am still fascinated by it more than 50 years after I first wrote about the subject, and I expect that to continue for the rest of my life.
What's one question that you would ask yourself about the gold market, which is to say that there's a research area or a topic of curiosity to you that you're still learning about?
I'm still endlessly fascinated by what central banks do and how they make their decisions. There's a lot of apparent similarities among what emerging markets have been doing, as I say, primarily buying. But then there are also within that coterie of emerging market central banks, there are a number of fairly substantial producers. And I'll mention just a couple: Uzbekistan and Kazakhstan, for example, which have always tried to buy as much as they can of local production. When they can afford to do so, given the economy of the country, then they like to put that into official reserves. But when they can't do that, or when they feel that perhaps they've already put too much into their official reserves, then they might turn around and sell. And we saw both Kazakhstan and Uzbekistan figure on the sell side in the first quarter of this year, even though for most of the last 13 years they have been part of this general trend of emerging market countries buying more gold. So I'm always fascinated by what motivates them occasionally to sell. I understand the motivation to buy quite clearly, and it's been explained to me by hundreds of central bankers over that 50-year period. But what would occasionally motivate them to sell is a very, very interesting area of research, and I intend to do more research. I'll be very happy as and when I come to any kind of clarity. If I ever do, I'll happily share that with you, David.
I do want to wrap up. I don't want to hold you too long, but I just want to comment on that. I had the privilege of speaking with David Dodge, who was the former chief of the Bank of Canada, and he presided over the Bank of Canada during a time when the Bank of Canada was selling its gold reserves. And as you know, the Bank of Canada is today the only G7 country with no gold in its reserves. And I asked him why they did this throughout the 2000s, and his answer was, in his words, gold is an antique, and we could find similar assets of the safe haven category that actually generate a yield. And gold just kind of sits there, where I'm paraphrasing now, gold just kind of sits there and doesn't do anything financially for us, is kind of his general rationale. Final words on that.
I've heard that kind of rationale from a lot of people, no question, not that many central bankers. It's interesting that when I was on Wall Street and working for a broker, I dealt with the Bank of Canada on a regular basis. We knew that they were net sellers because they had a mandate to sell. They did not have a mandate to buy gold. But the company I was with bought a lot of gold from them. And their explanation was rather different from David's. I'm not going to contradict him, but his predecessor's explanation for why they wanted to sell down their gold reserves was because all of the foreign currencies in Canada's official reserves at the time, and this is in the late 80s, early 90s, all of the foreign currencies in Canada's official reserves were borrowed. They didn't own a dime of any of those foreign currencies. So all of Canada's official reserves were in the form of gold. Now, I'm an investor who believes in gold, but I've never had 100% of my personal assets in gold, and I never will, because I don't believe in putting all my eggs in one basket, even if that basket is golden. And so I agreed with the people that I was dealing with at the Bank of Canada at the time that it made sense. 100% I thought was an excessive amount of gold for a central bank of an advanced industrialized country to own. And it made sense for them to be sellers. I think that's, to my mind, that's a much more compelling argument than the one you just quoted from David Dodge.
Excellent. Well, George, I appreciate your insights. Where can we learn more about your work and study and gain the 50 years of wisdom that you've accumulated?
My contributions to the literature appear regularly on ssga.com website, and I am just one member of a team at SSGA. I think probably a unique team for a major bank, which is devoted to researching gold strategy. So there's a wealth of good material on ssga.com. You can find us there.
All right, I'll put a link in the description below. Be sure to check it out. Thank you, George, again. I appreciate your time.
David, a real pleasure. I look forward to talking to you again soon. I wish you every success with the report.
Thank you very much. Pleasure is all mine, and as do I. I look forward to speaking with you next time. And thank you for watching my show. To the audience, thank you, and stay tuned for more. Don't forget to subscribe.